Hello everyone and welcome to ESG Matters. Today, we examine a notable governance debate in Japan's corporate sector. Kao Corporation has officially rejected a shareholder proposal by Oasis Japan Strategic Fund, bringing attention to discussions on governance, executive compensation, and shareholder influence. The proposal, submitted for Kao's 119th annual general meeting on March 21, 2025, sought changes to the company's board structure and executive compensation policies. Oasis recommended appointing 5 new outside directors, revising outside director compensation, and introducing stock-based incentives for both outside and internal directors. However, Kao's board unanimously opposed these changes, citing governance concerns and alignment with long-term strategic goals. A key reason for the rejection was the nominating committee's conclusion that the proposed director candidates lacked the necessary governance, industry expertise, and leadership experience to enhance board effectiveness. Kao emphasized that its existing independent oversight mechanisms already align with Japan's corporate governance code, with a goal of reaching 30% female board representation by 2025 and maintaining a majority of independent directors. The compensation debate was another area of discussion. Kao maintains a fixed monthly salary system for outside directors to ensure independence in corporate oversight, while executive compensation remains performance-based under the company's K27 midterm strategy. This framework, which was approved by a majority of shareholders in 2024, has demonstrated positive financial outcomes. Kao argues that Oasis' proposal to replace this system prematurely is unnecessary. Additionally, the company expressed concerns that stock-based compensation for outside directors could compromise their independence. Under the K27 strategy, Kao's financial performance has shown growth. Return on invested capital (ROIC) climbed from 4.1% in 2023 to 9.2% in 2024, with a target of 9.4% in 2025. Economic value added (EVA) increased from 149 billion Japanese yen in 2023 to 332 billion Japanese yen in 2024, and operating profit rose from 1,147 billion to 1,466 billion Japanese yen within the same period. Kao views these results as evidence that its current governance and incentive structures are working effectively. Beyond financials, Kao has continued strengthening its leadership team. The appointment of Sarah Casanova, former CEO of McDonald's Japan, aligns with efforts to strengthen the company's global branding and expansion strategies. These moves reinforce Kao's argument that its governance model is already structured for long-term success. The rejection of Oasis' proposal reflects a broader trend in Japan, where shareholder activism is gaining traction. However, Kao's response highlights the company's commitment to governance stability and strategic decision-making amid investor engagement. This case raises ongoing questions about how companies should balance independence with performance-based incentives while maintaining shareholder confidence. As we close, we'd love to hear your thoughts. Should companies adjust their governance strategies based on activist investor demands? How should corporate boards balance independence with performance-based incentives? Comment down below. Thank you for joining us on ESG Matters. Stay tuned for more discussions on the evolving landscape of corporate governance and shareholder influence worldwide.